Welcome back to adjustment entry number 7, payroll entries, EPF, ETF and PAYE. The EPF is the Employee Provident Fund. This is a retirement benefit scheme which employees of an organization contribute a small portion of their basic pay monthly. In the same line, the employer also contributes a similar amount on their behalf toward the scheme. Normally, there are two percentage applied, 8% and 12%. 8% by the employee basic salary and 12% from the employers. Some companies follow this method. 10% from the employee and 15% of the company. But these rates can be changed according to the management discretion. So, there are two types of contribution which is involved in the Employee Provident Fund. The first category is employees' contribution, and this is deducted from the employee's monthly salary. The second one is employer's contribution. The employer contribution considered as an expense of the business and it is charged against the income statement. So, how should the contribution be calculated? So, employer must calculate the percentage of EPF contribution on the employee's total monthly earning. So, this total monthly earning comprises with the following categories. The first one, salary, wage or fees. Then, the cost of living allowances, special living allowances and other similar type of allowances. Payment with respect to holidays. Cash value of cooked, uncooked or the food supplied by the employer to the employees, food allowances, other kind of remuneration, then the payment in the form of commissions, piece rates payment and the contract basis payment. So let's look at the journal entries. The first employer's contribution. So we are going to debit the Provident Fund contribution and we are going to credit it to the Provident Fund payable account until we are going to settle the payment. The journal entry for the employee contribution is as follows. First, we are going to debit the salary of the employee and from that salary, we are going to charge the Provident Fund payable and we are going to credit it to the Provident Fund payable account and the remaining is going to pay in terms of cash or sometimes the company can issue the bank check. So we are going to credit the cash or bank. Then finally the journal entry for the fund transfer. So you know that both employees and employers are contributed to the Provident Fund. So we are going to debit the Provident Fund bank account and we are going to credit the operational bank account. Then let's move on to the ETF. ETF is the Employee Trust Fund. Here, only the employers are contributing to this fund and the percentage is 3%. So, this is a social security program, right, established for the benefit of the employees. Here, this contribution is calculated based on the monthly salary. However, there are two categories of members are exempted from the paying ETF. The first one is the family members of a family business. The second category is the companies when the partners or the directors are the only employees. Now let's move on to a question. Here, the gross pay of Mr. A is 2000. Mr. A and his employer contribute to the Provident Fund at 10% of his salary. In this respect, the contribution of Mr. A for the Provident Fund is 8%. And he takes home by paying 1800 as the net salary. So they are asking what will be the journal entry. So here, first one, we are going to record the salary. So Mr. A has total monthly earning of 2000. From that, right, for the employees, they are going to pay 1840. And from here, 8% is charged for the EPF contribution. So we are going to credit the Provident Fund payable account by this value. At the time of Provident Fund deposit into the bank, so what will be the double entry? So we are going to debit the Provident Fund bank account, the employer's contribution, that is 200, and we are going to debit the Provident Fund bank account, the employee's contribution, that is rupees 160, and finally we are going to pay the operational bank account, this together as amounting to 360. So after paying to the Provident Fund, the payable account value will be 0. So how we are going to calculate the employer's contribution? So this employer's contribution considered as expense. So we are going to debit the profit or loss account or the income statement, and we are going to credit the Provident Fund account 200. At the same time, rather than crediting to the Provident Fund account, we can credit it into the Provident Fund payable account as well. Next one is pay as you earn tax, normally known as PAYE. Employers are required to deduct the income tax on employment income from the employee at the time of payment of remuneration or the salary. For this purpose, the Commissioner General of Indian Revenue specifies a tax table which are used in the making of such tax deductions. Since the tax is paid at the time of remuneration, this system is called pay as you earn system. So, according to your syllabus, most of the time we are going to record this EPF contribution, ETF contribution from the employer, and EPF contribution on behalf of the employee. Thank you, and next we'll move on to the next chapter.